Modern cars are effectively rolling data centers. KPIT Technologies serves as the digital architect for this shift, specializing in software-defined vehicles, where code determines the vehicle's capabilities as much as the engine or the chassis. For years, that focus made KPIT a standout performer. They consistently reported high double-digit growth, earning a reputation as one of the most reliable picks in the automotive technology sector. This chart shows KPIT stock dropping nearly 40%, hitting a 52-week low. The driver was a sharp deceleration in revenue growth. In fiscal year 2024, growth was 45%. By the third quarter of 2026, it dropped into the single digits. During this same period, quarter-over-quarter net profits flattened. This led analysts at JPMorgan and Goldman Sachs to issue major downgrades, describing 2026 as a washout year for the company's organic growth. Part of the volatility stems from how the stock was valued. KPIT was trading at a price-to-earnings multiple of 40x. At that premium, investors pay for the expectation of flawless, rapid expansion, leaving no room for slowdown. When a company is valued based on hypergrowth, even a minor dip in momentum can trigger a mass exit by institutional investors, regardless of how profitable the underlying business remains. This slowdown is not unique to one firm. Across the globe, the entire automotive industry is hitting a period of significant spending fatigue. Manufacturers are facing a difficult set of conditions. Electric vehicle adoption is slower than expected. The European market remains weak, and US-China tariff tensions are creating deep uncertainty for global supply chains. In response, major automakers have begun to freeze or reprioritize their research and development budgets. Programs that were once high priority are now being stretched out or delayed to preserve cash. Tata Elxsi and KPIT Technology Services. The sector-wide decline indicates a cyclical downturn. Yet, KPIT remains stable, operating with zero debt, high capital returns, and over $200 million in recent deal wins. The current challenge lies in the scalability of the traditional engineering model. Billing by the hour for engineering effort creates a natural ceiling when major clients decide to scale back their total project volume. KPIT's strategy to overcome this ceiling involves a shift they call mobilizing change. They are moving away from selling engineering hours and toward providing specific AI-driven software outcomes. A key part of this pivot is the integration of agentic AI. By partnering with Microsoft Foundry, KPIT is attempting to deploy these intelligent agents across the entire software development lifecycle for global automakers. These AI agents target the most time-consuming part of automotive software, validation. They can scan millions of lines of code to identify the exact source of a system failure automatically. Traditionally, finding a complex software defect across different vehicle domains could take specialists months of manual triage. KPIT's tools are designed to perform that same analysis in minutes. They are also applying this to autonomous driving through their Scenario Foundry. This platform uses AI to generate thousands of virtual driving scenarios, allowing companies to train their software without relying solely on physical road tests. This projection shows management's expectation for 2027. Their target of returning to high growth relies on the ramp-up of contracts signed this year and the successful market adoption of these new AI-driven platforms. The stock's recent 40% correction reflects a market waiting for proof of this transition. KPIT is currently navigating a difficult pivot, shifting toward an AI-led model to maintain its relevance in a shrinking spending environment.